Are you a higher rate taxpayer in the UK, handing 40% of your hard-earned income straight to HMRC? Here's the truth. There's a little-known investment vehicle that could legally slash your tax bill. It's called a venture capital trust, a VCT, and in this video, I'll explain how it works, the reliefs it offers, and whether it's right for you. Now, before we dive deep, quick disclaimer, I'm not a financial advisor. This video is for education only. Always do your own due diligence and seek certified advice where needed. What are VCTs? A venture capital trust is a UK-listed company that invests in small, high-growth businesses. Think of them as mini investment funds that support early-stage companies. In exchange for taking on higher risk, the government gives you generous tax breaks. Why? Because these businesses need funding, and VCTs channel private money into them. When you buy VCT shares, you're effectively backing UK startups, and HMRC rewards you for it. The main tax benefits. 1. 30% income tax relief. Invest up to £200,000 in VCT shares each tax year and claim 30% income tax relief. That means if you invest £10,000, you can cut £3,000 off your income tax bill. Immediate impact. 2. Tax-free dividends. Any dividends paid out by the VCT are completely tax-free. No higher rate dividend tax. 3. Tax-free capital gains. If you sell your VCT shares later for a profit, you pay no capital gains tax. It's a triple benefit: upfront relief, tax-free income, and tax-free growth. Who benefits most? VCTs are designed for higher rate and additional rate taxpayers. Why? Because you're the ones paying 40% or 45% tax, so the 30% relief is extremely valuable. Example: you're a higher rate taxpayer owing £20,000 in income tax this year. You invest £50,000 into a VCT, you get £15,000 knocked off your tax bill instantly. The rules you must know. You must hold the shares for at least 5 years to keep the relief. Sell earlier and you lose it. Maximum investment: £200,000 per tax year for relief. Relief only applies against income tax, not other taxes. VCTs are riskier than mainstream investments. They back small, often unlisted businesses. Risks of VCTs. Let's be clear, VCTs are not free money. They carry serious risks. 1. The businesses they invest in can fail, meaning your capital is at risk. 2. Dividends are not guaranteed. Some years you might get nothing. 3. Liquidity is limited. Selling VCT shares isn't as easy as selling normal stocks. 4. Fees can be higher than standard funds, so while the tax reliefs are generous, you must balance them against these risks. Who shouldn't invest in VCTs? If you don't already max out safer allowances like ISAs or pensions. If you need access to your money quickly. If you can't stomach the idea of volatility or potential losses. VCTs should be seen as higher risk satellite investments, not core portfolio holdings. Who should consider them? Higher rate taxpayers who've already maxed pensions and ISAs. Those comfortable with risk and long-term investing. People with large income tax bills who want immediate relief. Investors who like supporting UK innovation and startups. Step by step, how to use VCTs to reduce your tax bill. 1. Check your position. Calculate your income tax liability for the year. Are you paying £10,000, £20,000 or more? 2. Set an investment budget. Only invest money you can afford to lock away for at least 5 years. 3. Choose the right VCT. Research providers like Hargreaves Lansdown, Octopus, or other established managers. Look at dividend track records and sector focus. 4. Apply before tax year end. Relief applies to the year you invest, so timing is crucial. Deadline: 5th April. 5. Claim the relief. Use your HMRC self-assessment to claim 30% back. Keep all documentation. 6. Hold for 5 years. Maintain shares to keep the relief. Consider reinvesting dividends or using them as tax-free income. Examples in action. Case study 1. A London lawyer paying £25,000 in income tax invests £40,000 in VCTs, immediate relief, £12,000 off her bill. She also earns tax-free dividends yearly. Case study 2. A business owner with spare cash invests £100,000 across multiple VCTs, saves £30,000 in income tax, diversifies risk by spreading across funds. Mistakes to avoid. Investing just for the tax break without considering the risks. Putting in money you might need in under 5 years. Not diversifying. Picking one VCT instead of spreading across several. Ignoring fees. They can eat into returns. VCTs are a niche tool, but when used wisely, they're powerful. They don't replace ISAs, pensions, or mainstream investments. They complement them. Think of your financial plan like building a house. Foundations equals emergency fund, pensions, ISAs. Walls equals diversified mainstream investments. Roof equals specialist vehicles like VCTs. The roof protects against big tax bills, but you only build it once the rest is solid. With higher taxes still in place and government spending stretched, higher rate taxpayers are carrying more of the burden. HMRC isn't shy about collecting. That makes tools like VCTs more valuable than ever. But remember, tax rules can change. Governments tinker with allowances, reliefs, and thresholds all the time. That's why using them while available is key. Most people see tax as unavoidable. The wealthy see it as negotiable, legally. They don't dodge tax, they plan for it. VCTs are one example of planning smartly. This isn't about greed, it's about efficiency. You worked hard for your income. You paid tax on it before. Why pay more than you need to? Use the rules. Play smart. Keep more of what you earn. VCTs aren't for everyone, but for higher rate taxpayers, they can be a game changer, legally slashing your tax bill while supporting UK businesses. Comment below, would you ever consider a VCT, or are they too risky for your taste? And subscribe for more UK money fixes every week.